Hey everyone, if you didn't already know, Disney has announced huge content budget cuts for its streaming services across the board. And in this video, I'm going to highlight why that's really good news for Disney stock investors. So let's begin here. There's a question that came from Michael Nathanson on Disney's conference call that really touched on this and it drew out Disney CEO to answer the question in a detailed way that I think sheds a lot of light on why this is good news for Disney stock investors because Disney's streaming segment is a big part of the valuation of Disney stock. So this is crucial for the valuation going forward. So the analyst here asks, what's the impact of the slowdown of your content spending on subscriber growth? So as many of us were concerned when Disney announced that they're cutting content budgets, we thought, well, isn't that going to lead to subscriber losses? Aren't people going to cancel their streaming subscription if you're not spending money or as much money on content? That's a concern I had as well. But the CEO responded in a really interesting way, saying that we realized that we made a lot of content that's not necessarily driving subscriber growth, right? We made content that wasn't getting people to sign up. It just didn't have that value that we thought it was going to have. And we're getting much more surgical about what we make. So we're thinking more methodically about the content that we make, and we want to make content that subscribers want and that attracts new subscribers. So as we look at reduced content spend, we're looking to reduce it in a way that should not have any impact at all on subscribers. That's interesting, right? You might think of it like, how can you cut your content budget without having any impact on subscribers? I mean, from personal experience, I can share with you some of my videos that I make. It leads to, you know, either zero or very few subscriber additions. And then I look back on it and I say, okay, that means that people, viewers, are not interested in this content. So I'm less likely to make more content in that manner that didn't lead to views or subscribers. And so it's kind of like you're voting with your attention. You're voting with your attention. If you're not watching it, if you're not subscribing, if you're not hitting the like button, that tells me that you didn't gain much value from it and you don't want more of that kind of content. And then I look at another video that gets a bunch of likes and has a bunch of subscribers and people are commenting saying how much they like the video. Well, okay, that's obvious to me that people want more of that kind of content. And so I follow what my viewers want to see, and that's kind of what Disney is saying here. Like if they spend $200 million making this incredible movie that very few people watch and very few people come to Disney Plus for, they ask themselves, do we make another one of these? Probably not, right? We're not going to make a sequel of this movie that people don't want to see. This is where the streaming service has really informed Disney and is now starting to pay off. It's now starting to pay off because they get data, real time data on how consumers are responding to their content. Disney can open up the app and open up the KPIs and look at how many people are watching this movie that we just added to Disney Plus. How many people sign up to Disney Plus and this is the first thing they watch, right? That indicates to Disney they signed up for this one thing right now because the first thing they did when they signed up, they watched this new movie that we just added to the platform. So Disney gets informed like, okay, people are signing up because of this new movie or new show that we added to the platform. So that data is now informing Disney on what type of content to create, and they can now make decisions and say, okay, let's cut this, let's add this, let's cut that, let's add that. And that's what I think the CEO means by being more surgical and precise with their content budget, making more things that people want to watch and then reducing the budget in areas that people didn't want the content to begin with for some reason or another, and that should not lead to subscriber losses, because it's not like they're going to be cutting the most popular kind of things, right? They're smarter than that. They can see the data where consumers are really watching this show or this movie or this character. They're going to make more of that and less of the ones that people are not watching. So one thing they did notice is that the big tentpole movies are really great subscriber drivers, right? When they make a big hit movie, they release it in the box office, in the movie theaters. They spend a bunch of marketing dollars behind it. And then after its window in the movie theaters, when that movie comes out on Disney Plus, people are now interested in signing up for Disney Plus to watch this movie that just came out on the platform. It just went from the movie theaters onto the Disney Plus platform. And so that's been really successful in driving subscriber growth. And so now that's an area that they're going to dig deeper into, because they've realized that brings in very good subscriber growth. And from what I'm inferring from this, it means like less spending on some of the shows, the series that they spent pretty big budgets on, and they realize maybe it's not bringing in the subscriber growth that they were hoping for. So more spending on movies and maybe less spending on these series, these shows that are not bringing in the subscribers that they thought. So that's why I think the reduced content budget is good news for Disney stock investors, and it should not lead to, according to management, it should not lead to substantial subscriber losses, but it should lead to an increase in the bottom line. All right, that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.